Hello, friends, startups, founders, investors, and everyone watching this show. I am Tushar Kansal. This is a totally new show. It's called Startups Ask. The reason behind this show is that over the years on VCTV, we found a need for directly connecting with the startups, founders, the team, as well as investors and the people who form a part of the whole startup ecosystem. The need to answer their questions directly, give them answers from directly from the investors. And here I am today, every Tuesdays, 12 noon UK time, Startups Ask. That is where I will be. I will be talking about the startup funding, the startup dynamics, and the ecosystem. And then I will take your questions as well. You can type in your questions at the YouTube channel of La Token, at LinkedIn profile of La Token, or on Facebook. And happy to take all your answers, all your questions. Myself, Tushar Kansal. My company's name is Kansaltancy Ventures. I my in my previous life, I've been a part of private equity practice at Deloitte Touche, also India's largest fund by number of deals done called Brand Capital, and also headed treasury with the Russian telecom company MTS, raised almost $2.5 billion for the company, and was CFO with a logistics company owned by distribution Guggenheim Partners. Since the last 7, 8 years, I run Consultancy Ventures. We help startups, we help investors, we help them connect, we help them do quality, good deals across sectors, tech and non-tech. And very happy to be moderating this show today and be sitting directly in front of you and be able to answer your questions. So the theme which we have taken today is what investors want. So basically, there are a lot of theories and myths around what investors want in a startup, and it has caused some bit of confusions, some bit of overthinking, some theories, some logics. So let us take this one by one. What investors want. I'll be sharing a single slide with you, which will I will take you through. Uh, yeah. So the investors want to know more about your business. They want to know more about you. They want to know more about the sector. They want to know about the growth prospects. And these are just little some points which give us an indicative idea as to what investors want. The main thing is, are you solving a problem which directly impacts humanity? If Uber solves the taxi problem by a smartphone, it is a problem, big problem solved. If you are tackling environmental issues by lithium ion batteries or some new technology which lowers the cost and yet benefits the environment, it is a big problem solved. So, what is your problem statement? That is what the investor is looking for. And your solution to it. Your solution to it can be a simple one. You just import some product, put it together, find some distribution strategy. But the craziest ideas are which have intellectual property, which create something new, which uh, which have something which not only lowers the cost but is scalable. It grows very fast using technology. It can enter new markets, and those are the kind of ideas which the investors are looking for. So as we speak, please feel free, just type in the chat box on YouTube, LinkedIn, and Facebook, what do you feel about the problem statement and the solution. The problem statements of today's day and age They relate to health a lot because of COVID. They relate to mental health also because of the stresses, because of job losses and other things. They relate to the environment. They relate to a lot of causes which a lot of people think about and work upon. But end of the day, your solution to the problem statement should make money, should generate some return. Next point which investors look, now one investor told me that he looks for a founder first, product second. And this, a lot of investors have told me this. I am also an investor. I invested in an education company, exited 800 students, and it was very good exit which I got. I've invested in a consumer B2B product company and also in a robotic company, and in the process of investing in a fintech company. So, what investors feel is they are betting on a person, and that founder, he should be a hustler. I know of this founder. There is this 2018 pass out of aeronautical engineering from Moscow, and this guy, is a hustler. He wanted to set up a aviation academy here, and he wanted to meet the civil aviation minister. He got 2 3 wrong meetings where nothing happened, and then finally he went to the constituency of the minister, met the political party guy. 2 days he was sitting with the civil aviation minister. So those are the kind of hustlers who make dreams come true. So the team is the number one important factor for any investor. Who is he betting on? The product might take time to improve, might not be the right product, but the right team will always pivot its business plan and end up creating the right product which will succeed. So this is the belief of most investors. Next, market size and opportunity. Now, if your market is only $10 million big, then end of the day, your revenue, the business done by the company, won't exceed $10 million. If it doesn't exceed $10 million, the valuation of the company won't be too big. So the return generated by the investor won't be too good. So the total addressable market, the TAM, has to be sufficient. At least I know of institutional investors, VC funds, they say at least $5 billion worth of TAM, total addressable market. So if a company is betting on putting in money, if that company gets 30% of the market, it'll end up having a $1.5 billion revenue in a $5 billion market. So that is the thinking behind market size and the opportunity. The next is product. Product is very important. uh, in fact, there are companies who straight away show me the product, and I love that approach. In case the product is good, in case the product is not good, it creates a very adverse impression. So just write on the chat box, what do you feel about the product? Do you feel that the product is as important as the team, or more important, or less important? Then, business model. This is one of the very crucial pieces. Business model means, if it is a consumer product, whether you will be selling it D2C, direct to consumer, say online, or you will be selling it via distributors, or you will be uh, putting up in retail shops. What is your model by which you will be reaching out to the consumer? This includes the go-to-market strategy. It includes the product positioning, the branding, and the business model covers everything. Then the traction. The traction is very important. Uh, what is the business you are doing as of now? So if you are doing a good business as of now, the investor has faith in you. He says that they have already proved that this thing can earn money, and that is very important. So what do you feel about the traction? Do you feel that without traction also investors should put in money? write yes or no in each of the chat boxes. Then next, I'll take you through competitor analysis. Now, if I am, see, I as an investor, I want to understand your business, and I have already seen the competitors in the market. Now, how do I understand what you are trying to do if I don't know who is your competitor? If I know the competitors, I am already a sector expert. I know their business models. Immediately I can make out what is your business model. That is the importance of knowing the competitors. And if you are giving out names of your competitors to the investor, you should give out your competitive advantages, how you are different, how you are better, and across various points you have to give out how you are better. Then the investor really wants to know your financial projections in the next 5 years. What is the business you will do? And this includes both the top line as well as the bottom line, which is the profit. And then the ask. What is the amount you are asking for? A lot of companies, they when they are sitting with the investor, one founder will say $2 million, the other founder will say $400,000 because they're not sure. So you should be sure about your cash burn, how much time that money will last. The ideal scenario is at least 12 months, better if it is 18 months, and best if it is 24 months, because you don't want to spend all your time in looking for investors and investments. You want to focus on the business. So raise it for 18 months, 24 months. That is the importance of knowing how much funds you need. Then if you are asking for the investor, telling him we need $1 million, you have to tell the use of funds. You'll put it in marketing, you'll put it in team expansion, you'll put it in branding, you'll put it where will that money go, whether it will go in creating intellectual property. And so a lot of companies in today's times, which are tech companies, which scale up very fast, they put a lot of money in marketing. Now, as long as you are not employing 100,000 people, but using marketing tools available on the internet to scale up, there is no problem. But if you are putting the marketing dollars, you are not putting it in product, you are not putting it in innovation, but you are putting that money straight for just for marketing, then the investor will end up losing out, because your product should improve. It should uh, get the pull factor from the customers. Then future roadmap. uh, where will you be in the next 5 years, 3 years, 5 years? And these are the basic factors which basically each uh, investor wants to know. Now, you have to tell me, if you are a pre-revenue company, then should the investor look at you and put in money? Do pre-revenue companies, uh, how does the investor decide the valuation? There is a question here. In pre-revenue companies, how do you decide the valuation? It is a very interesting question. In pre-revenue companies, we decide the valuation by estimating the 5-year projections of the business once the business starts out. And we also do scorecard method and VC method. There are two other methods. VC method is a way of uh, scoring your company across different factors and comparing them with the competitors on each of the factor and assigning weights to it and calculating it. Discounted cash flow is one method where we make projections for 5 years, calculate the cash inflows available to the company, and calculate the total value of those cash inflows as on current date. So, pre-revenue companies, Y Combinator has ISAFE notes. ISAFE notes are basically a way of putting in money in pre-revenue companies, and you can put in money in pre-revenue companies by those iSafe notes. I will explain what these iSafe notes are. So you can take preference shares, convertible preference shares in the company, and the value at which the preference shares will be converted into equity will be determined by the next round of funding which will happen. So whatever value at which next round of funding is happening, a 20% discount to that, your convertible shares will convert. So this is a very simple way. Y Combinator even gives you an option that if you start to make good cash flows just after getting Y Combinator funding, and then you get another round of funding, you have an option of returning the Y Combinator's iSafe money as a loan, and you can pay just interest on that. So this is the ways valuation is done in um pre-revenue companies. Ask me any questions about your startup, about your business plan, about investments. Uh, the team is very important. Repeat again, uh, the team has to be balanced. If you are a product startup, you should have a marketing guy, you should have a finance guy, if you should have the technology guy, should have the marketing guy. It is not necessarily that all of them are shareholders in the company. It can be that there are two main founders and others are CXOs, or they are handling the departments. But the team should be balanced. And uh, so the investor likes to put in money where he gets a lot of confidence in the founder. Ask me other questions. You can ask me about what is a term sheet, for example, or how long does due diligence take, and what are the factors, how to decide. Okay, I have a question here: how to decide the amount to ask to investors. Now, this is very important. As I said, when you talk to startups, you ask them after understanding the business, what is the amount you want to raise. A lot of startups say that they want to raise, one founder says 2 million, the other founder says $400,000. So basically, you have to be very clear about your business plan. If you have 5-year projections, you know your uh, your revenue, you know your expenses, your cost, and you know all the other factors, and then you have a sense of the operating profit which the company is going to make, and that will determine the cash flow. So if all those factors are clear, then you can very well make out that what amount of funding you want to raise. And this funding should have the end use justification, that what would this amount be used for. And so basically, what amount to ask for? I would say, suppose you are a pre-revenue company and you are into education technology. Now, in India, the education technology multiples are going very high. The top companies like Byju's and the others, Unacademy, their multiples of they are running on revenue multiples. So if you have a pre-revenue company, no revenue, then you can ask for $1 million valuation or $2 million, but around $1.5 million. That is the kind of valuation you can ask for, provided your minimum viable product is there, or the product market fit is there, PMF. It doesn't be have it should not be at the idea stage. There should be something on the ground. So and if in case your PMF is already there and you already have a revenue, then of course you can look for much more valuation. And any other questions you want to ask? My website is there on the screen. It is consultancy.com. We help VC funds arrange money for VC funds. We arrange money for startups. We help startups by mentoring them. Myself have 22 decades of experience in the startup ecosystem space. And so let me take you through, before ending the show, let me take you through how does an investor issue a term sheet, and what does a term sheet contain? Yes, I have that question with me. So the term sheet is a statement of how much money the investor will put in, what are the terms and conditions the investor will have, till how long the investor wants to put in his money, what are the exit clauses available with the investor so that he can take out his money after 5 years, or 8 years. European money is very patient, 8 years. Uh, so the term sheet will have of how much amount, what is the instrument through which the investor is putting in the money, what is the control the investor will have on the company, what are his rights. Rights can be like he can have information rights, he can have rights on board of directors, he can have all those kinds of rights. Then exit clauses, that the investor will want you to exit by an IPO, or he would want to sell his shares to a third party, all those step down clauses. And so this is what thank you, Mahboob Rashid, thank you for your comment. And so I welcome you all every Tuesday, 12 noon UK time. Come to this show. Just get up to the YouTube link, Facebook or LinkedIn link of La Token VCTV. Happy to answer any of your questions. I am available on LinkedIn by my name, Tushar Kansal, Kansaltancy Ventures, or my email, which is my name, tusharkansal@gmail.com, and my website, consultancy.com, which is with a K. And for great news and shows, keep on watching VCTV. It was fun to address you all today, and I look forward to helping startups, founders, and investors every Tuesday, 12 p.m., 12 noon UK time. See you all. Thank you, and have a great day.